Hi, my name is Hussein Isa. Today I will be talking about ordered logistic regression, which is a specialized case of the general linear models that requires us to have a specific type of data, ordinal data. We will explain later on into more details what ordinal data is and how it is different from other types of data. First, we will discuss logistic regression, when it can be used, how it works, and then we will talk about ordered logistic regression. Again, when it is applicable and how to apply it. After that, we will talk about an application in the auditing field where an ordered logistic regression model is inferred from a controlled risk assessments dataset, which is a real business dataset, and how it can help us predict the expected risk level, which in turn can be used to verify the quality of auditors' control risk assessments. After that, we will conclude the lecture. Logistic regression is a nonlinear regression model that forces the output or outcome or predicted values or predicted variable to be either 0 or 1. In such cases where the dependent variable is not continuous, the assumption of linearity of normal regression models does not hold, and this is why when we would want to use a logistic regression model, for instance, whenever we have a binary dependent variable, and this is why it works well with dummy variables, and this is when you would have the dependent variable would take either yes or no, true, false, 0, 1 type of values. The logistic regression models, they estimate the probability of certain event occurring, of the desired outcome occurring. So for instance, if the dependent variable y is for a client to default on their loans, it would be y, or the dependent variable would take the value of 1 for defaulting and 0 for non-defaulting. Other examples that where logistic regression models can be used are actually very diverse, and like we can think of it with diseases in general. So for example, whether a patient has high cholesterol or not. In this case, if he has high cholesterol, y would be 1. If the patient does not have high cholesterol, y would take the value of 0. For fraudulent transactions, for example, y would be 1 in case of fraud, 0 otherwise. And again, we have many examples and many scenarios where we would have logistic regression models where they would fit correctly. The logistic distribution is cumulative in nature. As we can see, due to its probabilistic approach, it constrains the estimated probabilities to be between 0 and 1. We will see later on how the probabilities are estimated, and we will talk about the formula that allows us to do so. When the probability is higher than 0.5, it means that the outcome is more likely to occur. For example, in the case of fraud, if the probability is higher than 0.5, that means that the transaction is more likely to be fraudulent than not fraudulent. To fit a binary logistic regression model, we need to estimate a set of regression coefficients that predict the probability of the outcome of interest. The same logistic model, in fact, can be written in different ways. The version that shows what function of the probabilities results in a linear combination of parameters is the formula that we can see here. The quantity to the left of the equal sign is called the Logit. This is the log of the odds that an event occurs. The odds that an event occurs is what we get when we divide the probability that the event occurs by the probability that the event does not occur. And the coefficients in the logistic regression model, they tell us how much the logit changes based on the values of the independent variables. So, as we can see here, the logit is the natural log of p over 1 minus p. P is the probability that an event occurs. For example, that the outcome, that the transaction is fraudulent. And 1 minus p is the event that it would not occur. Because its probability, the range is from 0 to 1 for p. The odds ratio can go from 0 to infinity, while the log of the odds ratio, or the logit, this can range from minus infinity to plus infinity. Beta 0 is the intercept, and beta I is they would be the coefficients. And x, those are the independent variables. So if we have more than one independent variable, it would be beta 1 x1, beta 2 x2, beta 3 x3, etc. Now to recap what we talked about in the logistic regression section, the logistic regression can be used when we have a dichotomous outcome. Yes, no, true, false type of dependent variable. And the independent variables can be integral, can be dichotomous, categorical, they can be different types. They don't have to be just dichotomous. And here, what we're trying to do is to predict the probability of the outcome occurring. Like, again, in the case of a client defaulting on their loan payments, it would be given certain independent variables, for example, the income, marital status, age, how long they have their experience, how long they have been working, their education, etc. Based on all these factors and all these independent variables, the outcome would be 1 if they, like, the dependent variable would be default or not default. Okay, so now we get to the ordered logistic regression. When a response variable has only 2 possible values, again, like fraud, not fraud, occurring, not occurring, fail, pass, binary logistic regression is commonly used to test or model the association between that response and a number of potential explanatory variables or independent variables, with each association estimated in terms of an odds ratio. Now, multinomial logistic regression is an extension of this approach to situations where the response variable is categorical and has more than 2 possible values. Ordered logistic regression, or ordinal logistic regression, is a special type of multinomial regression which can be advantageous when the response variable is ordinal. So ordered logistic regression model is a nonlinear model that can be applied in the cases where the dependent variable has more than 2 values that have a sequential order. The distribution of a logit model is again cumulative, and where the event of the ordinal logistic regression model is cumulative rather than individual values. Okay, before we go any further, we need to discuss, we have been talking about ordinal values and nominal values. So we need to discuss this a little bit. Nominal values are mutually exclusive categories with no logical order. They are distinct values. It's like a license plate number, colors, phone numbers. It doesn't mean that one phone is better than the other, or if there is any difference, it doesn't mean that the phone number 1 is greater than phone number 2. Whereas ordinal variables, those are mutually exclusive, however, they come in a logical order. For example, grades, they come from A, B, C, D, and F. They come in a certain order. Risk levels, whenever we talk about risk level, it could be high, medium, low. We also have, so those, they are distinct. Again, they are distinct. You cannot say, for example, that 1 low plus 1 medium equals high. They are different. And we cannot say that from low to medium is the same as medium to high. All we can say is that they are distinct. However, they come in a certain order. The third type is the interval data. Here we have ordered data with equal distances between each point. So from low to medium, for example, it would be the same. Let's take, for example, the temperatures. When you go from one temperature to the other, if you increase it with 1, from Celsius, for example, you have 2 to 3 is equal to 3 to 4. Dates is the same thing. You have, let's say, the difference between February 18 to February 19 is 1 day, and the difference between March 18 to March 19 is again 1 day. So they are distinct, they come in order, and we know that the interval is in a way additive. So for example, if you go from let's say February 18 to February 19, and then you can add from February 19 to February 21, that would be 3 days. Same thing applies to the temperatures. Now, the fourth type of variables is the ratio variable. In this case, the data is ordered and we have equal distances between each point. However, we have a true zero. We have like a starting point. It's like, for example, length. You can have 0, and you can have from 0 to 5 is equals to 5 to 10. And if you put 0 to 5 and 5 to 10, you end up with 10. So why do we need to care, or why do we need to consider ordered logistic regression? Because many variables of interest are ordinal in nature. In other words, we can rank the values, but the real distance between categories is unknown. Take risk levels, for example. They are usually categorized as low, medium, or high. However, the distance from low to medium is not, or does not have to be, necessarily equal to the distance between medium to high. In the same way, students are graded on scales from A to F. However, to go from A to B is not the same as going from D to F. And examples of such ordinal variables are numerous. We encounter them all the time in our daily life. Whenever we fill in, for example, a survey, it could be a yes, maybe, or no. The answer could be strongly agree, disagree, strongly disagree. All these types of all these variables are of the ordinal type. So when do we need to use ordered logistic regression? It's whenever we have more than 2 possible responses to the or possible values for the dependent variables. So instead of using a dichotomous response, here we may use a polytomous response, or more than like multiple responses here. Take these two examples here. The nominal one, the values, all we can see here is 3 differently colored circles. However, there is no specific order. They are different, but we cannot say that one comes before the other. However, in the other set, when we look at it, we can see that we have that the light blue circle is smaller than the navy blue. And the navy blue in turn is smaller than the black circle. However, we cannot say that the difference in size between the light blue and the navy blue is the same as the navy blue to the black circle. So how do we calculate the ordered logistic regression? The formula is very similar to the logistic regression. Again, we have the logit, which is the natural log of the probability of an event happening over the probability of the event not occurring. So it's the log of the odds that a certain event takes place. We have beta t is the vector of coefficients. Again, we would have beta 1 x1, beta 2 x2 with x0 equal to 1, and that would make beta 0 the intercept. Normally, in general, the logit values are not directly observable. So what we can do is we can modify the binary logistic regression model to incorporate the ordinal nature of a certain dependent variable by defining the probabilities differently. So instead of considering the probability of an individual event, we consider the probability of that event and all the events that are ordered before it. In other words, in ordered logistic regression, the event of interest is observing a particular score or less. Take the example, take yi here, for example. Yi would take the value 0 if it's less than a certain threshold, if the logit value is less than a certain threshold mu0. And it would take the value of 1 if the logit value is between mu0 and mu1, etc. until we reach the last one, which would take the value of I when we have the logit value between lies between mu I minus 1 and mu I. We will talk about this a little bit later on when we discuss, when we give the example of the ordered logistic regression application in the auditing field. We will be seeing some kind of like a numerical example. We have talked about the predicted probabilities or predicted values. In this case, now we will talk about how we can calculate these probabilities or expected values. As probability, the range would be between 0 and 1, and therefore we need to transform any continuous values from continuous form to the range of 0 to 1. We use the formula that shows on the screen. Here again we have beta is the vector of coefficients in the same way as before, and this is the predicted probability that the record X would fall in the class I, or would take the value Ci given those independent variables. So for example, that would be the predicted probability that a certain transaction is of high risk, or that this is the probability that a certain transaction would be of a certain high risk. Again, we will have a numerical example in the application later on, when we talk about the application of ordered logistic regression in auditing. It is noteworthy to say that ordered logistic regression, many statistical softwares or packages can actually use for logistic and ordered logistic regression. SAS can do it. R, you can also use we can use different software to calculate the predict probability. SPSS, for example. Now we will talk about a study conducted by the Continuous Auditing and Reporting Lab in Rutgers University in the accounting department. In this study, an ordered logistic regression model was inferred from a data set procured or provided by internal audit department of a certain company, and that data included control risk assessment values. We used that data set to infer an ordered logistic regression model that would allow us to predict the risk level, and in turn we use that to review the quality of the auditor's judgment of when they were doing the control risk assessments. So to start with this, we need to see who cares about this study. Who are the audience? Who may be interested in something like that? We know that the internal auditors were very interested. The heads of the internal audit departments, because they can use it to review the quality of the work used by internal auditors, while internal auditors would use it, using this methodology to learn from the experience of other auditors. The supervisors or head of internal audit departments, they may use it to review the quality of their auditors' work. Business owners can actually use it where they can benefit from the knowledge and experience of auditors. External auditors also can use it to identify outliers, and again here we will also be identifying outliers and ranking them in order of let's say disagreement. As we know, the adequacy of internal controls is one of the most important risk factors. And after the accounting scandals that took place in the early 2000s, SOX 404 required management and external auditors to report on the adequacy of the company's internal controls. Moreover, Auditing Standard Number 5 encourages external auditors to take the work of internal auditors into consideration. However, this depends on the quality of the internal auditor's work. In fact, Auditing Standard Number 2 considers a low-quality internal audit function by itself. It is considered as material weakness. SAS number 65 explains that the quality of internal audit affects external auditors in 3 phases: during risk assessment, during understanding, documenting, and testing internal controls, and during substantive testing. Now, that being said, risk assessments are important, and are important for several reasons, and they affect annual audits on a micro level. This is when this is for the schedules, as well as a micro level. This is the decision to which extent to run substantive testing or to expand the controls testing. here we know that nowadays with the electronization of businesses, we see that a lot of data is being generated, collected, and stored. And the auditors, they are facing this huge data, which is creating some kind of a challenge to them because they cannot audit the whole data. And this is why there's some kind of a shift to audit by exception. This is, here we mean that the whole population is analyzed, exceptions are captured and identified, and those exceptions would be analyzed. The problem is that even those exceptions are too numerous to be able for human users to be able to investigate in their totality. So auditors, when they have to assess the controls, they actually have to deal with large amounts of information, and they actually end up with suboptimal results simply because they become overwhelmed and inundated with all these exceptions and with all this information. So what we are trying to do here is first to predict the values of the preliminary control risk assessments. Those are the expected values according to certain identified issues. And then we would use this predictive model to identify exceptions. Those are the cases where the predicted value would be different from the value that the auditors assigned. This would help us review the quality of the auditor's judgment. And finally, we propose a methodology that would allow us to rank those identified exceptions to make it easier for the auditors to address the more suspicious or disagreeing cases first. Why do we do that? We do that to answer the questions such as, how can we verify and review the quality of internal auditors' judgment? And how can we prioritize identified exceptions? However, first we need to discuss how the data is generated and the data that is used in this study. So the data in this paper consists of the identification and categorization of audit issues by process identified by the control assessment preparers, in addition to the overall process risk level assessments. It is provided by the internal audit department of a major multinational corporation, and it covers the period extending from fiscal year 2008 until 2011. The locations cover several countries, and the business processes include, but are not limited to, revenue, accounts payable, distribution, computer installations, etc. Now, during the process, during business processes, when internal auditors first they visit a certain location, they first identify audit issues related to the business processes, and then they classify these issues into three categories: non-major, major, or critical. Subsequently, the auditors use the information they procure from the analysis of these issues to categorize the overall business process risk level as low, medium, or high. So first, they identify the issues related to certain business processes and all the sub-processes. They would look at process 1, and then they look at sub-process 1, sub-process 2, sub-process 3. They identify issues related to sub-process 1, issues related to sub-process 2, issues related to sub-process 3. They categorize those issues, and then they give an aggregate score for the process, for the overall process, and then they assign an overall risk level of low, medium, or high. Now, the classification of each issue is based on certain criteria. They usually take into consideration materiality, the dollar amount, etc. Those are internal criteria set by the company. Now, the data that we had to undergo several transformations. We needed to aggregate the issues. Originally, the files that we had, they included separate files for issues and for the overall score. So we needed to aggregate the issues and to group them by fiscal year. So we would have total counts per audit work paper. We also needed to transform issues, scores, and overall scores from text to ordinal numerical values, which allowed us to use ordered logistic regression. And like we said, we had them by fiscal year. This is the breakdown of the data, and this is the total scores that we had here. And when we look at the data into more details, this is what we find. Those are the issues. Those are the total number of critical issues, major issues, and non-major issues that were identified, broken down by year, as well as the audit work papers. Those are the risk levels assigned by the auditors for the overall business processes, again, grouped by fiscal year. Now, the model that we used in the study is based on the ordered logistic regression that we discussed earlier today. Here, we hypothesized that the control risk assessment score is a function of the total counts of the three classes of audit issues. In other words, the dependent variable is the control risk assessment score, which as we can see is ordinal and can take the values of high, medium, or low. While we have the independent variables being the aggregate counts of the three classes of issues, which is to mean they are the aggregate counts of critical issues, of major issues, and non-major issues. As we can see from the formula here, the Logit is a function of beta 0, which is the intercept. It's a function of the three variables, and beta 0 is the intercept, while beta 1, 2, beta 2, and beta 3 are the coefficients for the critical issues count, major issues count, and non-major issues count, respectively. We have, as we discussed before, the Logit values are not directly observable, so we look at yi, which would take the value of 0 when the case is of low risk. It takes the value of 1 in medium risk cases, and the value of 2 for high risk cases. We talked again about predicted probabilities. Here, we used historic data from previous 2 fiscal years to estimate the coefficients, and then we used that later on to predict the scores for the observations from the subsequent year. So we used the data from fiscal years 2008 through 2010 to calculate or to estimate the coefficients, and then we used those to calculate the probability of each observation from fiscal year 2010-2011 being or falling in each of the three classes of the dependent variable using the formula that shows here. So basically, we calculated the predicted probability of each observation from fiscal year 2010-2011 being or falling in the high risk class, medium risk class, or low risk class. These are the detailed predicted probabilities for each of the classes based on the formula, on this formula. So as we can see here, for the high risk, first we calculated the high risk. Here we use intercept 2 because intercept 2 corresponds to the separates high risk from the other classes. In the second one, due to the cumulative nature of the Logit model, the part of the formula that is between brackets actually calculates the cumulative probability of the high and medium risk classes. And we use here the intercept of the logistic model that separates high risk and medium risk classes from low risk classes. So the intercept 1 separates the low risk class from the medium and high risk classes. That being said, in order to calculate the probability of a certain observation or a certain record being of or falling in the medium risk class, we need to subtract the probability of the high risk class, and this is where we see the minus calculated probability of the high risk. For the low risk class, it is simply 1 minus the other probabilities. Because it's a probability, the total should be equal to 1, so the calculated probability of the low risk class is 1 minus the other two probabilities. As we can see here, this is using Excel. We used the coefficients that were estimated using fiscal years 08, 09, 09, 10 that we got from SAS. We used those to calculate the predicted probabilities. So for example, this one is the calculated predicted probability for class 2, which is high risk. This is the formula. As you can see, it is very similar to the first one. This one, it would be the cumulative. Here we can see that this is using the intercept 2, which separates high risk from other classes. This is using intercept 1, which separates the low risk from medium and high risk classes. And we deducted the calculated probability of the high risk. And the calculated probability of the low risk is actually 1 minus the other two. As you can see, those are the issues that were identified by the auditors, and each record would have one assigned score. Now, based on this information, we can see that, for example, this is the assigned class, it's low risk. Predicted class is low risk. So the auditors assigned the same value as our model. However, if we look at the second one, the auditors assigned a medium risk, while the predicted value was of low risk. This is an exception. As we saw in the Excel sheet, whenever we had an assigned risk that was different from the predicted value, we considered this as an exception. And then we looked, however, we thought that it's not enough to just look at which ones agreed and which ones disagreed. We wanted to do more than that. We wanted to say how different they are, how disagreeing those exceptions are. Therefore, we propose to use two ranking metrics just to make sure that we were consistent in our results. One of them is the ratio, the other one is the difference. So the ratio is actually the ratio of the calculated class, the probability of the calculated class that was assigned over the calculated probability of the predicted class. The difference is simply the difference between the two. In other words, when the auditors assigned when the auditors assign a certain score, risk level, if it is different, we need to know how different they are. This is a numerical example. This is an actual example from the data set. This record has 0 critical issues, 2 major issues, and 3 non-major issues. According to the model that we inferred from historic data, and using the coefficients that we estimated, we can calculate these probabilities. When we look at this one, we look at the highest probability. In this case, it is 0.607, and this is the probability. This probability corresponds to the high risk class, which is to mean that this record is most likely a high risk case, and this is why the predicted class we assign it. The predicted class is considered the high risk class. When we looked at the score assigned by the auditors, we found that it was medium risk. Now, again, this does not mean that the auditors were wrong and the predicted value is right. All we are saying here is that they are different. We may ask, in this case, like the supervisors may go and ask the auditors to explain why they had a value that was different from the expected value. It could be a judgmental, like it could be under documentation. It could be, let's say that the auditors, they found that the management or like the business owners, business process owners were actually implementing some steps to mitigate that risk, and this is why they gave them a lower risk. In our case, all we're saying that it's different. We're not saying that one is better than the other. Now we want to know how far off the auditors were from the predicted value. We used those two metrics as mentioned before. We looked at the calculated probability of the assigned class. So the assigned class is medium. We look at the probability that this case is medium. The calculated probability that this case is medium, is of medium risk. And when we do the calculations, we find that the ratio is 0.64551 and the difference is 0.215. Now let's take another record. Again, this is a real record from the data. As we can see here, the ratio is 0.89 and the difference is 0.057. So as auditors, which record should they focus on more? They should focus more on the first record because the difference is higher. In other words, the disagreement between the auditor's judgment and the predicted value, the disagreement was higher. It was like they were further away from the value than in the second record. In fact, if we look at the calculated probabilities, So the calculated for the second record, it was like 53 to 47%, or like 0.53 to 0.47, which is really very close as opposed to the second one, which was more than 0.2, 0.20. In fact, the lower the ratio, the more suspicious the record is, or the further away or the higher the disagreement. And the bigger the difference, again, the bigger the disagreement. As we mentioned before, right now in the slides, we wanted to see how far off. So what we did here, we calculated the ratio. Again, it's the same as the formula for each records. Whenever we had a ratio of 1, that meant that this is not disagreeing. And in order to make sure that we were correct, we wanted to do the comparison. Now, all we need to do here is to just input the data, the aggregate numbers of the issues, and the coefficients, and we end up with calculating all the outliers or the exceptions. Those are the top 20 that we took into consideration just to make sure that we are consistent. The difference here, again, it's between the two. Whenever we have, this is the assigned risk level, this is the predicted risk level, we calculate the difference, and the higher it is, the more disagreeing it is. And then all we need to do again is just ask the auditors for explanation. We're not saying that one is better than the other, we're just saying that we need an explanation. What we found after examining all the outliers and mostly and ranking them, we found that the accuracy of the fitted model, this is when we used data from the 3 years and we applied the model to the 3 years, then we found that the accuracy is 93%, which means that the auditors, they systematically assign scores except for, let's say, like 7% of the cases where there's a difference. The predictive power of the model was, however, 76%. This is when we used the previous years and try to predict the values for the subsequent year. We always took the top 20 outliers and we sent them to the company for verification using both metrics. And we noticed that most of the time, because we use several years and several combinations for robustness checks, so most of the time the top 20 outliers were the same when using the two metrics. Now we found some interesting cases. For instance, we found 3 records that had no issues, but yet they were of high risk. That could mean that the auditors did not document all the issues. They underdocumented that. That could have meant that there was an error, or that could indicate some suspicious record. Again, we asked the auditors what happened, and they were able to actually go back and examine those cases, and they found that this was an interesting finding. This is an example of a graph that shows the non-major issues against the major issues, and using the predictive model, and this shows us the outliers versus the normal cases. This is the confusion matrix of the predictive model. as we can see here, those are the values that were assigned by the auditors, whereas those are the ones predicted by our model. So for instance, those are 142 records that the auditors assigned a low risk, and the value predicted by the model was also of low risk. However, if we look at this one, the model predicted the value to be of low risk. However, the auditors assigned them a high risk. Those are the three records that we mentioned earlier in the previous slides. And again, those were assigned high score, but the model predicted them to be medium score. So those are also other exceptions as well. Now, to conclude the lecture today, we talked about logistic regression, and we said that it can be used whenever we had a dichotomous outcome variable or dependent variable, which is to mean it can take a 0 or 1 value, yes or no. We also talked about ordered logistic regression, which works also when we have ordinal, which works when we have ordinal dependent variables. In other words, we have more than two values that have certain order. We also we discussed how we can use it to predict, how we use ordered logistic regression to predict the probability of a certain event taking place, and we saw that it has a cumulative distribution. As for the application of ordered logistic regression in auditing, we presented a study where we use ordered logistic regression in order to predict the values of control risk levels, and then we compared them to those levels that were assigned by the auditors. The cases that disagreed were treated as exceptions and were prioritized to have the auditors actually focus their efforts on the more disagreeing cases. And this methodology can enable external auditors to review the work of internal auditors and the quality of their judgment. And finally, we also this methodology could be also used as a consistency check, which would allow, let's say, junior auditors from gaining expertise from their more senior auditors or from the majority of the auditors, or business owners can also, business process owners can also use it to gain some knowledge or to gain expert or auditor-like knowledge. That would conclude our lecture for today.